Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are calculating Palantir Technologies PLTR stock's true fair value price right now according to the DCF model. So we've done this video multiple times before, but anytime we get new updates, we are going to reevaluate our price target for Palantir Technologies. However, this particular article that we're using has other fantastic information in it, and this is actually only point 3 of his overall thesis on Palantir Technologies. So I would encourage you to go down and click the link in the description where this article will be linked so you can read the entire article so you can be properly educated. However, in this video, we are specifically going to focus on their fair value price target according to this DCF model. Right now, the PLTR stock currently trades for around $10.40, while the low-end analyst price target for the next 12 months is $9 per share. The average price consensus for Palantir Technologies is $15 per share, and the high-end bullish price target for Palantir Technologies, according to analysts, is $25 per share. Around 11 analysts currently cover the stock, with 2 of these analysts saying to buy the company, 6 of these analysts saying to hold the company for a long-term hold. Then lastly, 3 analysts actually say to sell the company. With the current PLTR stock price trading at only around $10, we're going to see how much upside opportunity Palantir actually has according to this DCF model so we can get a proper fair value price target for the company. So when doing the DCF model and our analysis, we are going to be putting in key inputs and variables into our calculation so we can get a very adequate fair value price that is not too bullish and not too bearish, because we do want to be realistic with this particular price target. And right now, Palantir's management says that they are going to have a year-over-year revenue growth rate, or a compounding annual growth rate, also known as a CAGR, of 30%, which is very good. Anything 30% and over, particularly for a revenue CAGR, is very impressive. So I'm glad Palantir's management has at least prepared shareholders for this rapid growth in their revenues. However, this begs the question, can they sustain a 30% annual year-over-year revenue growth rate until 2031? Well, the answer to this is no. Management only projected this 30% CAGR regarding their revenues only until 2025. So we're going to take a more conservative estimate, and we're going to use a compounding annual growth rate for their revenues of 25% over a 10-year period, which is what we're going to discount out from. But the best part is, if we look at Palantir's performance for their revenues since their direct public offering, or DPO, on the public stock market, they actually have averaged around a revenue growth rate of close to 38%. So even though we are going to do a conservative price target and a fair value price estimate, this target could actually be much higher. We're also going to talk about their TAM, or TAM, which stands for their total addressable market, and because data is everywhere, it's actually hard to estimate a total addressable market for Palantir Technologies, but it's very large. I'll give you an example. If a small retail shop in a small town installs cameras or sensors to collect store traffic data, and they can correlate that to the weather or that particular month or the day, they can compare it to their overall foot traffic or what products are being taken off the shelf more often than others. And this will allow that small retail shop's management to actually understand their customers' wants to better utilize their overall store and platforms and products, which will in turn either lower expenses or increase revenue, or both could happen simultaneously. However, realistically, Palantir does not operate from small retail shops. They have very large institutions and government agencies that they cooperate with by signing contracts. So according to one of Palantir's S1 forms, they actually have a total addressable market estimate of around $119 billion, which is set to rapidly expand year over year. And we are going to attribute around $63 billion of this to their government segment and $56 billion to their commercial segment. Now let's talk about their ARPC, which is their average revenue per customer. And Palantir actually has a really good RPC, or average revenue per customer, because out of their 237 customers in 2021, each of them accounted for roughly $6.5 million, which is fantastic news. And this is going to work very well for their overall business model, which we are going to get into. Now, before we actually start the DCF calculation, we're going to have to continuously go over these various metrics and variables so you know what we are putting in the formula, and you know that I am not just fudging the numbers. What's even better is, as organizations and agencies as well as companies continue to become more digitalized in this day and age, and on top of Palantir introducing new platforms and products, their total addressable market as well as their average revenue per customer is expected to grow substantially over the next 10 years. This is going to allow Palantir better market penetration and better networking opportunities between various business segments. But to properly understand how fundamentally sound Palantir is, we are actually going to have to look at their business model. And their business model is divided into 3 phases: their acquire phase, their expand phase, and their scale phase. However, I do want to make a note of that customers are not evenly spread or diversified among these 3 phases. We honestly just want customers to be in the scale phase. However, to get customers into that scale phase, they first have to go through the acquisition phase and then the expanding phase. If we look at Palantir Technologies' 2021 10-K form, specifically pages 77 through 79, we actually get a fantastic definition of their acquire stage or their acquired phase. So it says that we define a customer as an organization from which we have recognized revenue during the trailing 12-month period. We define a customer or potential customer as being in the acquire phase if, as of the end of the calendar year, we have recognized less than $100,000 in revenue from that customer that respected year. So clearly the goal of their acquire phase is to gain new customers and eventually kick them over to their expand phase. And the 2 types of customers that fall into their acquire phase is potential customers as well as existing customers that are bringing in less than $100,000 worth of revenue. However, this is only the start of the business model because we really want to get them over to the scale phase, which is the most profitable phase of their business model, where their average revenue per customer is anticipated to grow exponentially. And because of this appreciation for their ARPC, we are going to put their compounding annual growth rate, or CAGR, for their ARPC, which is their average revenue per customer, for around 15%. So right now we have a revenue growth rate of 25% across the board for the revenues, and then for the compounding annual growth rate regarding their average revenue per customer, we're going to be using 15%. So now we have 2 metrics that we can use in our discounted cash flow model. So from here, we're going to actually see one of Palantir's greatest pitfalls. And their first problem is that for their average revenue per customer, it's actually distorted from their top 20 customers, which clearly bring them in the most revenue, which means that they are not diversified enough and they actually have too much weight in these top 20 customers. And if they lose any of these top 20 customers, it's really going to hurt their bottom line. However, the good news is that their top 20 customers actually reported around a 31% growth rate for their revenues in 2021 for an entire consecutive year. So that is really good that their top 20 customers are by no means looking to separate from Palantir Technologies, and they have actually doubled down on Palantir Technologies, which increases their overall revenues that they're giving to Palantir by around 31%, which is fantastic. And although critics will argue that Palantir is too heavily reliant on these top 20 customers and that it's dangerous, which I actually agree with, Palantir is a master of their scaling phase. So they have already wrapped these 20 customers into their business model, and these customers are very happy, and it doesn't look like they're going to be leaving anytime soon. So this is very low risk. These customers are clearly happy with Palantir, so much so that they are buying and purchasing and extending their contracts with Palantir Technologies, thus increasing their overall revenues. The next thing we need to be aware of, and that we're going to factor into this, is that their commercial segment and their commercial business will overtake their government segment in terms of revenues. And again, I've been saying this for months, way before the majority of analysts or reporters have even thought about this concept. In 2021, their government revenue made up around 58% of their total revenues, with their commercial segment bringing in the remaining 42%. And the reason for this is because of their Gotham platform, which is used as a major intelligence tool among intelligence agencies, and it does great work with defensive contractors, weapons contractors, the overall government segment, various military branches, as well as the overall intelligence community. Now, what I really like about Palantir, specifically for their acquisition phase, is that Palantir is so confident in their technology, and their technology is so sticky in their expand phase, that they will actually spend money or even give a free trial of their products to various companies, and they are so confident that that company will eventually sign a contract with them so they can move them from their acquire phase to their expand phase, that they will actually take a temporary loss on their acquire phase to then move to the expand phase where they start making really good revenues, to then move to their scale phase, which is what their top 20 customers are in right now, which is giving them the majority of their revenues. And this is how Palantir Technologies can scale their revenues extremely efficiently using using this Trojan horse strategy by giving either a free trial or a substantial discount just to get that particular customer in their acquire phase to move then to the expand phase. And to me, that's a genius move, and you have to be very confident in your technology that you're willing to take a temporary loss for a long-term customer. But overall, I actually think that this is an extremely interesting move that I think is very smart. I also want to point out that the reason that their average revenue per customer is so good and such a good statistic that we want to put into our DCF model is that Palantir has around 90 government customers, and they didn't really add any new government customers recently. However, their average revenue per customer for their government segment increased by 47%. So even though they did not sign a new contract, they still got loads of revenue from this particular segment. So for any critic out there saying that they are not expanding their government business, it actually depends on what you mean by that. Yes, they didn't sign any new contracts, but the revenues in this segment grew by almost 50%. And that's something to be very proud of, and eventually we're going to start seeing this in their commercial segment and their commercial business, which is what I'm really excited about. Besides average revenue per customer and their overall revenues, I also want to talk about their EBITDA, which is earnings before interest, tax, depreciation, and amortization, as well as their stock-based compensation, also known as their SBC program. So many naysayers and bears and people that talk negatively about Palantir Technologies always talk bad about their stock-based compensation, but I've done a plethora of videos on how their stock-based compensation is not only declining as time goes on, it also makes them an extremely competitive company because they get to hire top-tier talent because they get to pay their engineers more than other firms. So they are attracting the best talent in the entire world, and they can also pay that talent what they're worth so they can develop new platforms. And this goes right back into their business model because even though they're going to take a temporary loss in some instances about bringing in new customers, their platforms are so good because their engineers are so top tier that these customers are bound to sign up with Palantir into a very long-term contract. This is also going to be exacerbated because they are hiring new salespeople, which is just going to further new contract developments and new networking opportunities. However, in our DCF analysis, we're actually going to anticipate that their stock-based compensation expense is going to increase by around 20% in the next 2 years, and then slow to a growth of around 7%. But luckily, their revenues and their other financial metrics are outpacing this, so this is still declining in their overall stock-based compensation, which is overall very good. So if we hold this true for the next 10 years, on average, the dilution for their growth rate is going to be around 4%. Also, Palantir's gross profit margins, or GP margin, is around 78%, which is very healthy. However, it's actually anticipated to grow past 80% over the next few years, so we also have to put that calculation in our DCF model. And right before we do the calculation, I actually want to show you that the model is constructed to start from their revenues, and that's going to be applied to arrive at their earnings before interest and tax. And this is going to be phenomenal because just looking at their overall history, it's going to be phenomenal. But if you actually want to see the math and the projections, look on screen for the historical analysis from the end of 2031 all the way until currently of 2022. I know this is technically a projection, but it's listed as a historical analysis because we are discounting their cash flows from 2031 and going backwards, but before we do that, we actually have to project out. So that's why it's called a historical analysis, because we are actually working backwards from our projection in 2031 to get a proper DCF analysis. However, with these projections, what does this mean for the stock's current price, and what is Palantir going to be valued at right now? Well, according to these statistics, this would make Palantir's intrinsic value per share in 2022 worth $25.61, or approximately around $26 per share. This would imply around a 125% upside potential for investors that have an average cost basis for the PLTR stock ranging from $10 to $11. So this is a very bullish price prediction, and this actually almost exactly matches the analysts that say to buy Palantir stock, because clearly they are using the DCF model to get their $25.30 price target. However, in our instance, we calculated $25.61. So when I go over their price targets, I only just say $25 per share. So a $25 per share price target for Palantir Technologies in 2022 that they could potentially reach in the next year is very good, and it has fantastic upside opportunity. However, the reasons why this might not happen in the next 12 months, even though technically the company is worth this from an intrinsic and fair value standpoint, the thing holding back Palantir Technologies is not just internal problems, but rather external problems, such as macroeconomic factors such as rising interest rates, rising bond rates, and geopolitical tensions, as well as wars. And this is not affecting just the PLTR stock price, this is affecting the entire stock market right now, which is why I think it's fantastic to start dollar cost averaging into very safe ETFs such as VTI. While the stock market is going down, this is the time to invest very safely or invest in a high conviction plays. But if you like how Palantir has an intrinsic value right now of over $25 per share, remember to go and smash that like button right now, subscribe if you are new, comment your thoughts down below, and I will see you in the next YT video.